All right, I've gotten so many requests now to make this video, so I finally had to do it. Today I'm going to show you the 5 things you need to know when ordering IUL illustrations, and make sure you stay till the end because I'm going to give you a pro tip that's really going to be useful. So number one, when you call up a company and you want to order your own in-force illustration, a couple things are important to remember. Number one, you have to ask for all the inputs exactly correctly. Now, sometimes you're going to get an experienced person who will guide you, but most of the time you're on your own. So the first thing you want to do is you want to make sure that you let them know that you want to pick the index rate. Now, I generally, okay, speaking, like to try to run one at 4%. Some people are going to think I'm crazy for that. They're going to say that's way too low. Why would you do that? I want to see something more conservative, especially if you're in a situation where you're unhappy and you said, okay, you know what, it hasn't been performing. I need to see what's going on here. You want to set the index rate at 4%. Now, even the company representative might say, well, that's really, really low and really conservative. That's fine. We just want to see what it looks like at 4. Because again, if it hasn't performed even at 4% this far, what would make you think that you'd want to run it at 5%, right? So let's try to shoot for 4% and see what that's like. Now, again, you want to look at the allocations you have. A lot of times with IUL, there's all these proprietary buckets. And these proprietary buckets always look really exciting on an illustration because they can have like, 200, 300% participation rates, all these crazy things attached to them. But in my view of it, I haven't seen a lot of them do very, very well. In fact, I've seen banks be very happy to create these proprietary partnerships with insurance companies because they're bringing money to their bank, but I haven't seen a lot of performance out of these things. That's just me personally. Proprietary buckets are going to be indexes that you don't recognize, right? Unless it's the S&P 500, the Dow Jones, or the NASDAQ, it's probably some type of proprietary mixed bucket. And even the S&P 500 buckets can be volatility controlled and all these things. I just like looking at the annual point to point for the S&P 500 and the monthly point to point. If there's a good monthly average, which means they give you a high participation rate, that's what to me makes it good, then I would throw some of that in there as well. I've seen monthly average do very, very well. So I look at those 3 for the S&P 500, or if they have, like a NASDAQ or Dow bucket, that'd be fine too. But I'm going to try to focus for simplicity on the S&P 500. So you want to pick your index rate and you want to make sure that you're actually in that index. If you're in some goofy proprietary index that you've never heard of, well, don't expect it to earn 4% if it's earned 3 years of zeros, right? So you need to be able to look at these allocations and determine it. Now, I'm going to touch more on that at the end for my pro tip. So you want to pick the index and the allocated interest rate that you're assuming for that index and those credits. Okay, number 2 is you want to pick what you're solving for. So this is very confusing because a lot of companies can only do one solve at a time. So a lot of times what you say is, okay, I want to solve for no further premium and I want to see it run to maturity. Okay, what does that mean? That means they're going to solve for what the policy has to earn for to get to maturity. Now, another way you could do that is say, hey, I want to show no further premium, okay, and I want to make the index rate 4. What do I need to solve to make my death benefit drop to in order for that to happen to carry to maturity? Now, maturity is probably going to be age 100 with most companies, which means they'll take you to age 120. Just pay premiums to 100, and then they'll make 100 also equal 120. Sometimes it doesn't work that way at all. Sometimes 100 is 100. So again, you got to know what kind of company you're working with in terms of what their maturity date is. But I always like to see things run to maturity. And I'm solving for what variable needs to change in the equation, right? There's premium you're putting in, there's what it's earning, there's what you're loaning out, there's how you're loaning it out, there's when you change your death benefit, there's other things that can occur. And so, this is what you really want to be paying attention to is what are we trying to solve for? Do we want to pick our index rate and our premium and our loans and have them solve for what the death benefit needs to move to? Or do we want to say, what do I need to put in terms of premium to get this? Or do I need to say, what do I want it to earn in order to get this, right? Those are the kind of the variables you're choosing between. So again, you want to solve for one of those things. And again, this can be very complex. And so it's really, important to work with an agent. Now, I'll throw in one little bonus pro tip right now. You want to check with the company to see if they put any index bonuses in there. Sometimes companies can put what's called a non-guaranteed index bonus in their illustration. It makes them look better than they actually do. Like in year a certain year they'll turn on and they'll start giving you these little index credit bonuses. Again, those can really make an impact on an illustration. You want to make sure the company's stripping all that kind of stuff out. You don't want anything that's not guaranteed in there because it may just look good on an illustration. And you want to get some accuracy in terms of determining what you actually have and the course you're on. So learning what you're going to solve for is really important, right? Remember, if you're picking your premium, you're picking the loans, you're picking the loan type, and you're picking the interest rate, then you need to solve for what the death benefit's got to move to in order to corroborate that to get it to work, right? Now, again, if you get your in-force illustration back and it's like lapse at age 70, lapse at age 76, lapse at age 68, okay, now you know that's not going to work and you got to go back to the drawing board and get some more illustrations. Another pro tip is when you ask for these illustrations, companies sometimes will quote up to 10 business days. just request a rush and say, look, this is a really important decision. I need to get this information sooner. Can you rush to me? Usually they can turn around right away. Illustrations do not take a long time to run. I always get frustrated when companies are like 10 business days and we're going to mail them to you. It's like, you could press this button in 2 seconds and shoot an email. But again, that's just, part of the servicing when you're going with an insurance company directly. And this is why you want to work with an agent on getting your in-force illustrations. Okay, another thing you want to pick is your loan type. Okay, so a loan type you can withdraw down your basis. You can do a fixed loan, which is not a loan type, by the way. That's just withdrawing out your basis first, because life insurance has unique privileges to do that. You can, and again, basis means the money you put in. You can do a fixed loan, which is also known as the wash loan. You could do a index loan, and some companies offer a variable loan. Okay, now the way I look at it is variable and index are going to look the best, meaning they're going to give you the potential of that positive arbitrage that everybody wants. So again, if you have an illustration in your hands originally that you were sold and you want to determine, will my loans hold up, you were probably shown variable loans or index loans. The fixed loan is a more conservative loan. It's what they call the wash loan. They're basically going to give you enough interest or almost enough interest to cover the interest rate, but you're not going to get that index participation. Withdrawing down your basis is the safest way to take money out, in my view, because there's no interest rate assessed to the company. You're just taking out your basis. Now, that may not be the most efficient way to use your policy. I'm just saying, to me, that's one of the more conservative ways to take money out. I typically like the fixed loan. I'm going to pick the fixed loan because it's a more conservative route. If you show yourself a variable loan, you could be showing yourself a fairy tale, right? Because you could be showing yourself something that's getting really massive positive arbitrage. The interest rate is low and they're not showing the interest rate adjusting, which it can. And so that's kind of, dangerous. I like the fixed rate loan. You can just lock everything in and see what it's going to be. Now, they can adjust the fixed rate loan as well. So again, all these things have moving levers and you got to be cognizant of this. So you want to name your loan type. Again, if you're trying to buy an IUL and squeeze income out of it, I would discourage you from doing that right there. Run your loan scenario, see what it looks like, what it can produce income to. You can request income to 95. You can request income to maturity. You can request income for 10 years. You could get to pick what you really want to see. But again, these lifetime illustrations coming out of life insurance can be very misleading and they can be very enticing. So you want to run these in-force illustrations to determine what your policy can actually do. Next, you want to pick your premium mode. So again, you want to say, okay, how much am I going to fund? Am I going to fund my regular scheduled premiums as designed in the contract? Am I going to fund less? Am I going to fund more in a shorter period of time? Am I going to fund for longer? Am I going to fund monthly, annually, quarterly, semi-annually? You need to name all this stuff. All of it has an impact on when your money gets in the policy, when it can start earning index credits or interest. And the absence of it can create even, potentially higher fees as well. So you really want to be aware of the premium mode you're going to pick when you go to order these illustrations. That one's pretty simple, and you just want to make sure you get that one right too, because sometimes people forget and then they get a different mode than they were planning on paying, and that has an impact on your illustration. Last thing you want to choose is your death benefit option. You're going to choose option A, which is a level death benefit, or option B, which is increasing. Now, option B is often used when you want to cram a lot more money into the policy. You want to make it look more attractive. You can start out lower. Death benefit will gain over time. What's dangerous about option B is in a lot of these illustrations that you're being sold, at some point that illustration is showing switching over to option A and leveling it out to curb the fees from the death benefit increasing. That's a maneuver that does not happen automatically. You have to do that. So if your agent's not servicing your policy and 16 years from now you're supposed to switch your death benefit to level, that now becomes your responsibility. Even though it's not the way it should be, your agent should really help you with it. That's what's going to happen. So you really want to make sure that death benefit's level. Now, starting out at level can be disadvantageous because you're going to be paying potentially higher fees earlier than if you started with a lower death benefit and it was increasing. I still like level. I think it's going to be a safer option in a lot of cases. It's going to protect that rising cost from the death benefit increasing every year and the cash value not keeping up. That creates a further and further risk gap that can be really problematic and can sometimes be irreparable and can put your policy off course. So I would make sure that you're showing switching over to level and making sure you have notes all over your policy, timers, things set on your calendar to make sure you don't miss that, because you're going to need to make sure you're doing that if your agent's not there to help service the policy. Now, here's the pro tip. One thing you want to check on is your renewals. So you want to look at your annual point-to-point cap. What did it start at when you bought the policy? What is it today? You want to look at your monthly point-to-point cap. What is it when it started the policy? What is it today? If you're seeing a sharp decline down and you're seeing them cutting interest rates, cutting renewal rates, cutting your cap, that is not good. Remember, if you started out with a 14% cap and now you're down to an 8% cap, that's 6% you lost out on that you were anticipating from when you originally bought the policy. That is potentially detrimental. An 8% cap is very, very, very difficult to earn probably the original 6% return you were trying to earn earlier. Remember, it has to cap out many times in that 10-year period for you to be able to get it. And here's what's tough about indexing. The market could be doing well and you could still miss your index segment because of some bad timing. So again, you really want to be careful to make sure you're checking on your caps, those renewal rates. If those renewal rates are dropping, that's an indicator that you could be in a situation that you're not going to want to be in for very long. So again, I hope this video was helpful. If you like more content like this, go back and check out my other video I made on IULs on how you should know if you should keep it. It's going to be right here. And again, thanks so much for taking the time to watch this video. I'll see you soon.